Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, the regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining us this afternoon, we have Steve Wyett, Chief Investment Strategist at BOK Financial, as well as Steve Sosnick, Chief Strategist at Interactive Brokers. We're here to discuss the degree to which tariffs will matter for the economy and for the markets. It's great to see the dream team of Steve's, as always. Steve Sosnick, let's kick it off with you. We know we're getting tariffs. We know there's going to be a change in Fed composure and policy. How it impacts the markets and how it impacts the economy, those are two very different things, and I think it's something that we need to address.
Absolutely, Jill. It's very important to remember that the markets and the economy are very closely related, but they're not the same thing, and they can move in different directions and frequently do. One of the things I'd written last week was about what I call the death of the taco trade, as it were. I was never a big fan of that acronym to begin with. That stands for Trump always chickens out, and that was sort of became a popular thing as the tariffs switched. Either got modified or pushed back after the big April swoon. And the reason for that was, I think, less that he was chickening out than just listening to the market. I think the traders appreciated that the president, whom they expected to be listening to the market, was doing so. And that, I think, was the bigger aspect of the trade. And to me, the death knell was that we got the tariffs implemented as of last Thursday, and nothing happened. So if the big trade was about the tariffs not occurring, and then the market didn't flinch on Thursday and then zoomed higher on Friday because it was a Friday, for lack of any other necessary reason, then you can't use that as an excuse for why the market would have been rallying. Market rallied for many other reasons, but not because the president chickened out.
Yeah, I think it's a good point that you make. And when we come up with these acronyms, sometimes it paints you into a corner. And whether you agree with the administration's execution or not isn't the point. I mean, it's a negotiating tactic at the end of the day. So it might not necessarily be chickening out. It's just you're pivoting around strategy. And I will give the administration that. Steve Wyett, I think we also need to think about, markets at all-time highs, how the economy is, looking to process some of the risks that are going to present themselves as tariffs kick in. We also have to recognize that the Fed is going to have a change of policy and shift. And I just think the conversation around the Fed in general, in terms of how the dynamics of data are moving around as well.
Yeah. Hey, Jill, and hey, Steve, good to see you today. Look, I think there's so many moving parts in the economy and how this is all affecting. I would say this as far as what the stock market's done, and Steve, see if you agree or not. But the fact of the matter is, kind of like the Fed, we've been waiting to see the impact of tariffs on the hard data, and it just really hasn't been there yet. Earnings came in for the second quarter. I think we were, what are we now, at 13% year over year, and we were looking for something like 6%. And then when you talk about the Fed, we had a Fed governor resign. We've got a temporary appointment coming into place. Whether he's approved by Congress or by the Senate, ratified by the Senate in time for the September meeting, is still a bit of a question. I'm going to go out on a hunch here, though, Jill, and say if he is, I'm going to bet that he's thinking rates should be lower than they are today, just based upon what's happening. And so it still would be, what we have, 2 dissents at the last FOMC, first time since 1993. We went back and looked at some data, though, before the mid-90s. Dissents were a lot more, they have more prevalent, and there were more of them. And so something has changed, and maybe it's when the Fed looked for transparency, for better or worse. This transparency at times, I think, is kind of a nemesis for the Fed as they think about what they're doing. But clearly the political pressure is there. And Jill, I would have to say this. I think the employment data that we got a week ago last Friday has probably changed some of those views of the around the mandate for full employment, that it's pretty clear that the delta, the rate of change in the employment market, is towards a slower employment level. And so since the Fed is restrictive at the present time, there probably is room for the Fed to lower interest rates and not be at risk of spurring the type of economic activity that might awaken inflation in a way that they don't want either.
That's a good point that you make. But Steve Sosnick, your notes, you made another great point that when tariffs do take effect, and if in fact it is passed down to the consumer, I think the consumers that have been spending, it's not going to impact them as much. These are higher income earners. They're investing. They're getting some sort of tax breaks through, the new legislation that we have in place. So I don't think the composure is necessarily going to change in terms of who's spending and where. Perhaps on the lower income earners, how they're accessing credit as an example, that could be a read into the consumer. But I think those who have been spending and investing, it's not going to move the needle quite as much. So it makes you wonder, is it a complete picture?
Well, that's kind of the issue here, and taking into account all Steve's points, which I generally agree with. I do think what's a little lost here is that the possibility of a K-shaped recovery, where you have the higher end, those at the higher end doing just fine and perhaps even better, thanks to wealth effects, thanks to investing, thanks to tax situations, et cetera. And those at the lower end of the income spectrum being more subjected to tariffs because they spend higher percent just by definition. The less you earn, the more you have to spend as a percentage of your income. You don't have the opportunity to save and invest. And I'm not enough of an economist to say where the break point in the K is. Is it 50-50? Is it 75-25? Is it 25-75? But that's not, and that's kind of the issue, is that the 25 basis points here and there isn't going to matter much. And, to some extent, actually, I agree with what Chairman Powell said in his press conference, which kind of spooked markets a little bit, which came out. I wish he probably would take it back with the hindsight of the jobs revisions, but it was, we may be at a somewhat restrictive policy stance right now, but it's not really restrictive in terms of speculation, in terms of restricting anybody, in terms of restricting much. And I will take that to a larger extreme and say that think about what the current interest rates are actually restrictive of. Is it stock market speculation? No. Is it credit market? Is it credit spreads? No. Is it highly speculative behavior in cryptos and things like that? No. So there's not a lot that it's really restricting. So 25 basis points would be nice. And to Steve's point, I don't think it will disrupt anything. I think it will kind of help the market's mood. But the bigger risk that for markets when it comes to interest rate cuts is the why, not so much the whether, it's the why. And that is, if the economy is really getting weak, a few 25 basis point rate cuts are not going to do it. And it would mean that by definition, the Fed is late, and that's a real problem. If it means that the economy is relatively benign, that the tariff effects on inflation are relatively modest, which they are so far, and the labor economy could use a little kick in the butt, then 25, 50 basis points here and there would be welcome.
Yeah, that's an important distinction to make, Steve Wyett. And I would also make the argument 25 basis points, 50 basis points, even if we got a full 1% cut, which to Steve Sosnick's point, then you have to start asking why, or, we've seen such drastic cuts. I think something like the housing market, that's not going to move the needle. It's not going to change affordability. It's not going to change the fact that insurance rates for your homes are up 25, 30%. It's not going to change the fact that taxes are rising. 25 basis points, 50 basis points is not going to change that monthly payment that much because there's inflation in other areas that go into housing that are not going to be cheaper just because there's lower interest rates.
No, I think that brings up the exact fact that the Fed does not control mortgage rates directly anyway. They influence them for sure. But I think mortgage rates are still higher than they were when they cut 100 basis points starting last September and October. So, this is where when we look at the president certainly wants lower interest rates. He's calling for rates of 1%. We're not going to see that. But the fact of the matter is that even as the Fed cuts interest rates, how that affects consumers. So you mentioned how they're financing. Home mortgage rates may not come down that much. I got to tell you, credit card rates are still over 20%. 25 basis points is not going to help you. If you're having to fund your personal budget with the use of credit card debt, 25 basis points is not going to help you. And Steve, just to put some numbers on that K-shaped type of a recovery, I was doing a little research over this weekend, and just looking at the impact of aggregate inflation since the beginning of the pandemic, we've seen CPI, headline CPI is up about 26%. Think of that. We've lost 26% of our purchasing power since the beginning of the pandemic. That's well ahead of where wage increases have gone. So this is where lower end consumers that you talk about are feeling that. But home prices are up over 50%. The S&P's up 111. So to your point, if you've been fortunate enough to be involved, a homeowner and involved in the capital markets, you're better off today than you were when the onset of inflation. But if you're living on a paycheck to paycheck basis, man, it is really hard. And this is where I think, I think the Fed feels that. They also know that their actions have that impact on the upper 50% as well, and they don't necessarily want to add to that. Money supply, as we know, we went through the pandemic, increased some 40%. The stock of money is still very high. Yes, the cost of that money has gone up some, but I think your point is excellent. When we think about how restrictive the Fed is, what are they restricting? We are still seeing, we see meme stocks kind of coming back. We see some of the recent IPO activity that just looks, wow. They are really on fire. So I'm like you. I can see where Fed Chair Powell can justify keeping rates the same. I can also build a case for why rates should be going down some. But there's risk to both of those views, both of those actions or inactions.
And to your point about the housing costs, you raise a very important one there. Most mortgages are priced off of the 10-year, not off Fed funds. I guess there may be some ultra short-term floating rate mortgages, but for the most part, the 10-year note is where it goes. And so the paradox is if the Fed cuts rates too aggressively at the short end, the yield curve can get much steeper, meaning that the 10-year that while we see short-term rates come down, we see longer rates go up because more inflation expectations get built in. So it actually can have the perverse effect of making housing more expensive because it becomes harder to finance. So they really have to tread a fine line here.
Yeah. And well, it's a good point that you make. And this is outside of even what the Fed can do in terms of not manipulation, of adjusting interest rates. This is a housing policy issue. It's a one vote issue, if you will. Interest rates are not going to move the needle in terms of supply and demand. I think this is an interesting dynamic where we are right now relative to the way the market looked 5 years ago when you couldn't keep a house on the market. It was just going. You look at, there's multiple listings where they're relisting and just cutting back on the price of the home because it's simply unaffordable. Right. So
we are starting to see more of that. I'm sorry, Steve. We are starting to see a little bit more of the price adjustments. But in the end, Jill, this is a supply issue. And I would just say this, that if there is any movement in mortgage rates or you see prices down a little bit, there's an underlying level of demand in housing for the existing supply stock that if you're thinking the idea is that housing can go down a lot from here, that we just think that that's very difficult to have that outlook when you just think of the supply and demand aspects. I will say this, though. I've read a couple of articles and talked to my kids, and it's almost like they're giving up on buying a house. It's like they've almost just given up. And that's really discouraging. As you think about how we grew up and what how we kind of viewed what we wanted to achieve as we move through our professional career, giving up on housing, man, that's a tough one to swallow.
Right. Well, it makes you think, okay, what's the picture going to look like 15, 20 years from now, right? There's going to be a glut somewhere, whether it's on the supply or demand side, what that means for building wealth or wealth erosion for that matter. Steve, we probably read the same article where the age of buying a home is the highest that it's ever been. So you have older millennials that are buying homes for the first time. And what's interesting with that, the paradox with that is you become house rich and cash poor, because it's one thing to go from renting and calling the super when the refrigerator breaks versus when the roof leaks. Someone who just bought a home for the first time almost 5 years ago, it's shocking, right? So it's a very dramatic shift in thinking when you see, okay, here's my 20-30% down payment that I have, you're talking hundreds of thousands of dollars, that's gone, right? And so your house rich because the values have gone up. But then, you need cash to be able to sustain that. There's a lot of dynamics that millennials are dealing with right now.
You're the super on that, right?
Yep.
Jill, you're the one that's responsible for that upkeep, and it does add up. And to your point on inflation, man, I just look at insurance. My homeowner's insurance just renewed. It was up. One, the cost of insurance is up some. The home prices have appreciated. It's just a double whammy. It was 15-16% move. And man, you just go, I'm looking at a scenario now where, and I know a number of people are like this, my P&I, principal and interest part of my payment is smaller than my taxes and insurance part of my payment. So I'm looking at that going, wow, even when I get this thing paid off, I've got X number of thousands of dollars every month just to continue to live in this home. So it is a bit eye-opening as you go through that. Yes.
And health insurance, by the way, has gone up even faster for those of us who, I'm fortunate to be, employed by a company that provides health insurance, but those who have to go acquire health insurance, which includes many younger workers, that's not cheap either. So all these costs are mounting.
Yeah, well, perhaps some of the state AGs need to have a conversation with the insurance companies to make things more affordable and think about policy there. Appreciate both of your insights. As always, thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Market Reporter at Nasdaq.